cash flow business, and it's a very front-end loaded business where all the costs go in up front, and it's negative for the first 2 or 3 years, and hopefully prices will bail you out. And the third thing I'd mention is that the way the stock market has been restructured by computerization and commoditization and the like, what happens is that you have algorithmic traders, or they're known as algo traders. There are about 400, 800 in the market every day, in and out, for instance. But these guys index the price of crude to stock prices. Most of these people who do this could not tell you the difference between a ham sandwich and a refrigerator or whatever, but they are indexed. And if crude goes up, and in the last 2.5 years it's gone from 26 to 80, we've seen a major recovery, regardless of the economics or the value that you would impute to these companies. So it's become kind of a crazy quilt of computerized guys who are trading their brains out, and you get very false signals as to what companies are really worth. Anyway, enough of me.
That's really interesting and worth listening to. John was one of the early skeptics on Enron, so he's a guy worth listening to. And while I knew that Wall Street was playing a huge role in this industry in ways that aren't appreciated, I did not know the extent of it. It's an interesting observation. Any more questions? Go ahead.
Did you read Art Berman's blog reaction to your New York Times editorial about the magnitude of the debt in the oil field?
I actually did not, no.
So just to quote or paraphrase Art, he said, there's not enough debt to crash the economy this go-round. Have you got any thoughts about that?
Right.
Whether there's enough out there that's being vaporized as we speak to precipitate another crisis?
Right. So I actually agree with that. The New York Times ran an op-ed based on my book a couple of weeks ago, and the headline, which is my fault, I think overstated the thesis. You don't get to see headlines before they put them on pieces, and I think if you read the piece, it's a little more nuanced than the headline would suggest. But the headline said the next financial crisis lurks underground. I actually would not make an argument that the amount of debt in the fracking industry is going to cause a financial crisis. I think the repercussions, I think the issues are far more severe and far more existential, which is this whole issue of how much oil and gas would we be producing if companies had to live within cash flow? How real is this if the money were to dry up? That said, I do think there is the potential for financial problems, and I'd point it out in two ways. One is that fracking debt is just part of a larger pileup of debt that is a result of ultra low interest rates, and skeptics are looking at all sorts of ways in which that could unwind. I think the only good news on that front is that usually where everybody's looking for the next financial crisis actually isn't one. So if we all keep talking about it, we're gonna push it off and make sure it doesn't happen. But the second issue where I do worry that there could be wider spread financial problems from this is that in this era of ultra low interest rates, pension funds have not been able to earn a return in traditional fixed income markets, and so they've been investing in riskier assets, including private equity and distressed debt, credit hedge funds, and a lot of that money in turn is going into fracking, into shale. And so I worry if the returns aren't ultimately there, what that means for an already severe, that could exacerbate an already severe pension crisis, which I think is a financial problem that the country is going to have to reckon with. So I think there could be larger financial repercussions from this, or it could be a part of a much larger financial reckoning that we're going to have as interest rates start to climb.
So I think this is maybe a math question. If you take like all the excess dollars that went into the fracking space, and then you divide those by the extra barrels of oil that came out. Have you ever run that math, and what is that?
No,
look like?
I don't know. I think that would be a really interesting analysis. But hard to get at. And the problem with that sort of thing is that it is changing constantly because it's changing based on the price of oil, right? And it's changing. The economics of this industry change every minute of every day, and that's something that why I realized it was so complicated, because you have additional profit opportunity from higher oil prices. At the same time as oil prices start to increase, service costs in this industry also start to escalate dramatically, thereby wiping out some of that opportunity for profits. And so I think it's very hard to arrive at a predictive analysis.
Bethany, did you bring up in your book about the decline curves?
Yes. So the key part of the economic argument for why this industry will never work, and back to your point, John, about how you invest a lot of money up front and then you get cash flow in later years, but part of the argument for why that will never work for shale is that the decline rates on the wells are so steep. So decline rates on fracked wells are much steeper than on vertical wells. So you invest a lot of money in year one, and then you have to invest a lot of money in year two, and then you have to invest a lot of money in year three. And so the question is when you can ever stop investing all of that money, particularly if you're a publicly traded company and you need to show growth in your production numbers. So yes, you can make a good return on a single well, but if you're in a publicly traded structure and you need to show growth to your investors, that growth comes at an increasingly higher cost. And so the question is, if technology brought to bear in fracking ever starts to reduce the decline rates to the point where it starts to make more economic sense. So and another ongoing question is if improvements in technology have definitely increased the initial amount of oil and gas that we're getting out of wells, but whether we're just pulling that forward or whether there will actually be more production over time is another important question that I think is still unanswered. And one of the challenges in this is that this fracking revolution is really only a decade old. It's really not old at all in the scheme of things, and so we don't know that much yet. We're at the beginning in all sorts of ways, and some of the ultimate answers could prove to be more positive than they look right now, and some of them I think could prove to be more negative. I think one of the big lessons we have learned is that not all land is created equal, and so there used to be this belief, and I write about this period in Chesapeake's history in the 1990s when they were investing in this area called the Austin Chalk, and touting how great all the wells would be because one well was really good. And it turned out most of the other wells in the Austin Chalk were not good at all, and this one well was an anomaly. And you see, despite that lesson, you see something of the same dynamics happening today, where a company will show investors, 80% returns on one well that it drilled, and you're supposed to extrapolate from that one well and say, look how great all their land is. All of these wells are going to produce 80% returns. But then the fascinating thing is, in these companies' financial statements, you go from the investor deck showing the 80% returns on a well to the financial statements where the company doesn't make a rate of return at all at the corporate level. It's like, well, what happened? What happened between these fantastic rates of return and this negative rate of return at the corporate level? And part of the answer is obviously heavy corporate expenses, but another part of the answer is that all wells are not created alike, and you're getting to see the one well that does really well, but not all the other wells that didn't do as well. There's a question back there.
The mini book format, was that something that was your idea? Was it the publisher's idea? Should we expect to see more of that just in general? I was kind of intrigued by it.
It's an interesting idea. So Columbia University started this mini book format a couple of years ago, and the book I did on Fannie Mae and Freddie Mac, which that is definitely not a beach read under no circumstances, was the first one they published. And the idea is that with the decline in print journalism and the lack of budgets in most newsrooms, Columbia was going to provide an alternative way for authors to take on important, hopefully global topics in a longer format that still wasn't book length. And so these are meant to be faster reads. In some ways, that means that they're limited. I think this was in some ways a sort of a challenging topic for this format because there's so much I ended up having to leave out. But it makes it something that you can digest in a relatively short amount of time too. I think whether you'll see more of it or not, I hope it works. I think it's selfishly, it's great for me to have an alternative out there where I can take ideas that are perhaps too serious or wonky for magazines. So I hope we see more of it. But I guess it depends on whether you all enjoy the format, right?
I would mention, if I may, just back to Aubrey for a second. He was a great landman, but there's a gentleman and he was a land player. That's pure and simple. Everything else was secondary to him. A very good guy, but he hit overpass at 79 miles an hour with a huge insurance policy on him. And if you do the math, and I'm not going to say that, but the other thing I was going to mention is that if you ever want to get an interesting perspective on Aubrey, there's a gentleman here in town whom I don't know, but runs circles around Aubrey. His name is Joe Greenberg. And you might really benefit from him because he hit so many land plays with perfection, whether it's the Bakken Shale or the Haynesville or whatever. But he's the home run hitter, the Babe Ruth of the last 10 years.
Interesting. Yeah, there definitely is. There's so many multiple facets to this industry that it's hard to find a character who encapsulates it all. So I used Aubrey to illustrate one aspect of it, which I think does have larger implications for the industry, but by no means is the entire picture. So, go ahead.
So, as you've been out talking about the book, when you were at the Petroleum Club today, what have you gotten questions or comments that you went, oh wow, I maybe missed that, or that give you a different perspective, or that you might think about anything a little bit differently?
Not yet. I'm sure that will happen, and I've gotten.
It didn't happen today at noon.
No, I've gotten comments that have certainly revealed to me that even after spending a lot of time on this, I don't know everything I could. And that was another humbling thing about working on this book, is that everywhere you turn is a rabbit hole that you could go down and never come out. But there's nothing about this industry that is simple. Even trying to think about whether exported LNG will ever be cost competitive, or what the real impact on Russia will be of the U.S. being able to export LNG, or the differences in various types of oil that are produced, or other characters who have been instrumental in this story whose names I still haven't heard. There's so much more to this, and I think that was humbling during the process of writing the book, and slightly scary, and is still humbling today. I by no means feel that I know it all, but I think the financial facts of the industry are pretty indisputable. I mean, in the end, numbers are numbers, and even companies are quite aware of what's going on, because there's frustrated investors have started to push back and say, you guys need to produce returns. We're tired of this. So this idea that the industry hasn't made a return for shareholders is maybe something that executives don't like to talk about, but they all know it's true. So I think that's a tough pushback. And I think if I were less nuanced about the outcome, I probably would get more pushback. But the ultimate kind of, speaking of humbling, was my inability to really arrive at a conclusion as to where this was going. And it's either a strength of the book or a great negative, in that I don't have this is all a giant scam that is going to blow up in everybody's faces, or this is the future of America. To me, it's just not that clear cut. And so that, I guess I said, that's either a strength or a weakness. But because I'm open to arguments about why it might change, I think it's hard for people to say that I'm wrong in that way, if that makes sense. So, but thus far, no. I think that the headline on my op-ed opened me up to the most criticism that I've gotten, the idea that this was going to cause the next financial crisis. And I get headlines, so it got a lot of attention, that's for sure.
I was going to ask if you'd given any thought to your future news novella being perhaps about
where we're headed financially with renewables.
Yeah, I think that, and that to mention yet another kind of humbling area of all of this is just every single renewable could be its own book, from solar to battery to wind. I mean, you could spend years of your life trying to figure this out and trying to figure out when it's going to be cost competitive and what the future is and how soon that future is going to arrive. So it would make a great little book. The only surprising thing, as I mentioned, that I arrived at was just that people think it's closer than I would have expected. I would have thought financial types just would think that renewables were the province of wonky environmentalists and that they wanted nothing to do with it, and that is so beyond not true. That it was interesting. To wrap up, thank you.
Well, please, a round of applause for Bethany McLean. I just want to thank you all so much for coming out to Brazos this evening. Have a good night.
Thank you all very much.
Thank you.